Hi, and welcome to the International Insurance Society. I'm Josh Landau, the president of the IIS, and I'm excited about our partnership with BlackRock. I'm pleased today to introduce Michelle Edkins from BlackRock, who will present the evolving nature of stewardship. Michelle Edkins is a managing director in BlackRock's investment stewardship team, a group that engages companies and others in the investment stewardship ecosystem to promote the governance and business practices aligned with long-term value creation by the companies in which BlackRock invests on behalf of clients. Michelle is responsible globally for institutional relations, policy on investment stewardship issues, and communications related to BlackRock's investment stewardship perspectives and activities. She also serves on the firm's global operating and government relations steering committees. She's an alumna of BlackRock's Women's Leadership Forum, Enterprise Leadership Program, and Human Capital Committee. Ms. Atkins is an active participant in the public corporate governance debate and regularly speaks and writes on the importance of good stewardship for company performance. She was named in the NACD Directorship 100 Governance Professionals list for the past 7 years. She's also a fellow of the Aspen Institute's First Movers Program and a former chair of the Board of Governors of the International Corporate Governance Network. She currently serves on a number of industry initiatives to enhance governance and sustainable business practices, including the Advisory Council of the Value Reporting Foundation, the U.S. chapter of the 30% Club, a market initiative to increase the number of women on boards and in senior management, the International Institute for Sustainable Development, the Sustainability Accounting Standards Board Investor Advisory Group, and the CECP's Strategic Investor Initiative. Welcome, Michelle.
Thanks so much, Josh. And thanks to all of you for taking the time to hear a little bit about investment stewardship at BlackRock. It's a great opportunity to share our thoughts with industry leaders in the insurance sector, and that's really important to us as a key stakeholder group. So why stewardship? BlackRock is a fiduciary investor on behalf of our clients. So all the money we invest is client money. And the money that we represents the futures of millions of people across the world. They are the true share owners of the holdings that we have on their behalf in public companies globally. The vast majority of our clients invested in equity strategies at BlackRock are invested in index. So 90% of the roughly $5 trillion that we invest in equities is long-term locked-in capital. And we see it as part of our fiduciary approach to take on that responsibility to engage with public companies that our clients are going to be long-term shareholders in, to promote the corporate governance and sustainable business practices that we believe are contributors to long-term value creation. And it's over the long term that a lot of these factors that are sometimes considered non-financial, such as governance, such as sustainability, really play out in company performance, much more so than some of the idiosyncratic features of individual companies. How do we do it? So BlackRock Investment Stewardship is positioned as an investment function. We basically bridge the various equity strategies within the firm. And our aim is to be the voice of our clients as long-term shareholders and to provide constructive feedback to companies so they understand our perspective and we can build mutual understanding with them about their approach to these factors that we consider important to long-term economic value. There are 3 ways that we conduct our stewardship program. The first is what we call engagement, that direct dialogue with company leadership. Sometimes it's with board directors. Sometimes we meet with members of the C-suite. Most often we're meeting with general counsel and then institutional or investor relations counterpoints because they are best positioned to deliver their firm in that kind of dialogue. We also vote at shareholder meetings, and I'll talk about that in a bit more detail in a moment. But voting is the more formal feedback mechanism that shareholders have, as I'm sure many of you appreciate. And we try to use that vote very thoughtfully for those clients who have authorized us to vote on their behalf. And then thirdly, through market level engagement, through dialogue like this, through responses to public policy consultations, and through publishing our own position papers, we aim to promote high standards in corporate governance at the market level. We're also aiming to be very transparent in what we do. As I mentioned, we do all our stewardship work in the interests of our clients. And so it's important that they understand what we've done on their behalf, but we have found it very helpful to the companies that we're engaging, that they understand our thinking around key issues that we may be talking to them about. We also, by regulation, must publish our voting record annually, and we in fact publish an interim voting record every quarter, so clients and others can see how we've voted in a more sort of frequent phasing, because often votes on critical shareholder meetings are of interest in the moment rather than after the fact. We publish our voting guidelines so companies know what to expect and can anticipate any gaps that there may be between their practices and what we would consider to be good practice. And then, as I mentioned, we publish position papers on emerging issues and on topics that we believe may not be voting issues, but are definitely factors that we would like to discuss with companies. And then importantly, we publish our activity reports. So clients and others can see how we've engaged, who we've engaged, and what outcomes were achieved through that engagement and voting. Now, the focus of this conversation is about evolution in stewardship. And I've worked in this field for over 2 decades. I started in a role at a UK pension fund. And at that time, it was very much a role focused on voting at shareholder meetings and really not much dialogue with company leadership. The evolution over the last decade or so is definitely a shift away from just voting at shareholder meetings, proxy voting as we call it in our language, to having much more of that interaction with companies to ensure they do understand investor expectations, to be sure that they have an opportunity to explain their approach and perhaps make the case for taking a slightly different approach than maybe is expected as a sort of standard or norm within the market. Since 2020, BlackRock has been much more specific about including sustainability factors in everything we do in terms of investing for our clients. And that clearly also relates to how we conduct investment stewardship. So we have integrated a lot on climate risk into our process, and we have a paper on our website talking about how we engage companies on climate risk and the energy transition. We've also expressed our views on how companies should manage their impacts on people. And that proved to be incredibly helpful grounding for the engagement that we had with companies as they were responding to the COVID pandemic, looking out for their employees, looking out for their communities, and then how they determined the best way forward as they got more on an even keel and came through into a sort of more steady state operating position. The thing that hasn't changed is our focus on governance. We strongly believe that who's in the boardroom and who's in the senior management team is incredibly important to a company's long-term success. That tone at the top is the area that we focus on the most, and that is reflected in our engagement and our voting, in the sense that 60% of our engagements in the past year focused on board quality and effectiveness. We have a series of engagement priorities. The first being, perhaps not surprisingly, board quality and effectiveness. And we're looking to see that boards can demonstrate that they have directors who are engaged and experienced and diverse and bring diverse perspectives to the board decision making. Because in our experience, diverse boards with critical skills that are clearly aligned with the company's long-term strategy are best placed to support management in delivering on that strategy and ensuring that the right operating practices are in place to manage downside risk. We have also, for a number of years, asked companies to articulate a very clear long-term strategy that also explains the milestones against which investors can assess progress. And part of long-term strategy, in our view, is having a clearly articulated purpose. There's someone much more famous than I who said that purpose and culture eat strategy for breakfast. And we see that play out, and we certainly saw it play out during the response to the COVID pandemic. Companies with a strong purpose tended to have more engaged workforce and tended to find their footing more quickly than others. Our third priority is compensation that rewards long-term performance. As I mentioned, I've been doing this quite a long time. Compensation is a hot topic every year, and we're really looking for companies to demonstrate that executive leadership get rewarded when shareholders and other stakeholders have had a positive experience over that same time period. Our fourth priority is climate and natural capital. As I mentioned, in 2020, the firm went out very strongly to say that BlackRock's investment conviction is that climate risk is investment risk. And we are engaging with over 1,000 companies in a very focused way, and that list of companies is on our website, to encourage them to publish a strategy that aligns their business model with the long-term goal of reaching net zero greenhouse gas emissions by 2050. Part of that requires short, medium, and long-term target setting. And we really encourage companies to provide that information in line with the recommendations of the Task Force on Climate-Related Financial Disclosures. As we see that as becoming the benchmark reporting standard for companies addressing climate risk in their business. And then our fifth and final engagement priority is company impacts on people. And this has two key focus areas. One, companies as employers, human capital management, how companies are ensuring that they understand the needs and expectations of their workforce and they're meeting those expectations. And then human rights, how companies understand their impacts on people outside the immediate company and how they're mitigating any adverse impacts, but also making it a positive experience for those stakeholders to interact with the company. So how does this all work in practice? We have a 70-person team, which is globally coordinated through roles like mine, but regionally based. So to give you a sense of what that means, for companies based in Asia Pacific, the team is represented in Tokyo, Hong Kong, Singapore, and Australia. And so through having that structure, our team can engage in the context of the local business environment, often in terms of local languages, and really understands the dynamic within which companies are operating. And that applies also to the Americas and to Europe, the Middle East, and Africa. We engage where it matters most. So we had 3,600 engagement meetings last year, this dialogue around our engagement priorities and around our thinking on voting, with 2,300 unique companies. And that represents the majority of our clients' equity assets under management. There's a long tail in the way that our clients invest. And so we really focus on those companies where our clients have most value at risk, but also where we think our feedback can be helpful to companies. And usually that's companies that have a dispersed shareholder base. And we use the vote at shareholder meetings to signal concern, where we think a company is falling short of where we would expect it to be given the risk or the opportunity in their business model, or where there's clearly been a failure of management or board oversight if there's been a particular operating event or some other development that may impact the company's long-term value. And so last year we voted at 17,000 shareholder meetings, and our main signal of concern in our voting is voting on director elections. In practically every market, the directors on the board must stand for election periodically. In a lot of markets, it's now annual, but it's every 3 years as a minimum in the other markets. And last year, we voted against the re-election of 10% of the directors who stood. So that is a really important accountability mechanism from our perspective as a long-term shareholder on behalf of our clients. So looking forward, we're at the time of year where we review our policies and we nuance them based on the feedback that we've had over the year from our engagements with companies and our engagements with clients. Our voting guidelines and our engagement priorities are grounded in achieving outcomes that we believe are most aligned with our clients' long-term economic interests. And I think that's incredibly important to emphasize, because in some of the public debate, the issues on which investors are focused are sometimes presented as being something other than related to financial returns or long-term value creation. And we bring it back to this point every time we have a conversation with a company, every time we have a conversation with a client, that we are focused on achieving an outcome with the company that will contribute to value creation over time, and in that time frame that our clients are going to be shareholders. We announced just this week a very interesting development, we believe, which is we are offering some of our clients what we are calling voting choice. So for those clients who have a strong conviction around stewardship and voting and would like to retain that vote themselves, we're providing them with more tools to be able to do that. And we think that's an interesting development in the stewardship ecosystem, because it's one of those areas that, again, 10 years ago really flew under the radar. But over the past decade or so, more and more clients have taken a keen interest, and more clients are keen to express their own voice in relation to the companies that they hold shares in. And we're enabling that for them. And then finally, we're looking to advance practices on our own part, but also in the broader market context, to ensure that we're making progress on achieving the economic security that our clients depend on to meet their long-term financial goals. So thank you.